For the first time since the collapse of the Bretton Woods system in 1971, a massive shift is here. Global central banks are buying gold at a rate that we have not seen in over 55 years of trading. They are continuously dumping United States Treasury bonds and replacing them with physical gold bars in their vaults. This is not a conspiracy theory. It is a mathematical fact confirmed by the official World Gold Council data. In 2024 and 2025 alone, these institutions bought thousands of tons of physical metal. This level of accumulation is a screaming siren that the people who run the money system are scared. They are losing confidence in the United States dollar, and they are preparing for a new monetary order. If you want to understand why the elites are fleeing to safety, you must subscribe to this channel right now. Hit the notification bell so you are alerted the moment we release these critical financial updates. We are the only channel digging into the raw central bank data to bring you the truth about the reset. Leave a comment below telling us where you are watching from, and if you own any physical gold today. I read every single comment to see how this silent gold rush is affecting your local economy and sentiment. The story begins with a quiet report released by the World Gold Council that went largely unnoticed by the media. It confirmed that the buying spree, which began in 2022, has not slowed down but has actually accelerated. The central banks of the world, particularly in the global south, are engaged in a synchronized gold run today. They are collectively deciding that the risk of holding American debt is now higher than the risk of holding gold. This is a fundamental reversal of the financial logic that has governed the world for over 50 years. Since the 1970s, the U.S. Treasury bond was considered the risk-free asset of the global system. Central banks held dollars because they were safe and liquid and paid a reliable interest rate to the holder. Gold was viewed as a barbarous relic that paid no interest and cost money to store and insure annually. But in 2026, that logic has been turned upside down by the weaponization of the dollar system. The decision to freeze the reserves of the Russian central bank in 2022 changed everything forever. It sent a shockwave through the halls of every central bank from Beijing to Brasilia to Riyadh immediately. They realized that if they crossed Washington politically, their savings could be deleted overnight with a single keystroke. This political risk introduced a new premium into the market that the US dollar cannot shake off easily. Suddenly, the safety of the Treasury bond was conditional on your political alignment with the United States government. Gold, on the other hand, has no counterparty risk and answers to no government or president on Earth. If you hold physical gold in your own vault, nobody can freeze it or sanction it or delete it remotely. This realization sparked the buying frenzy that we are witnessing in the charts today across the entire globe. The leader of this pack is undoubtedly the People's Bank of China, which is the whale in the room. For 18 consecutive months, they officially reported adding to their gold reserves without a single pause in buying. But the official numbers are likely just the tip of the iceberg of what they are actually buying secretly. Analysts believe that China is using proxy entities and sovereign wealth funds to buy gold off the books. They do this to avoid spiking the price before they have acquired the tonnage they need for safety. This covert accumulation is estimated to be double or triple the official reported figures we see in public data. They are systematically swapping their massive trade surplus from dollars into hard physical assets to protect their wealth. But China is not acting alone in this pivot away from the Western financial system and the dollar. Poland has emerged as a shock buyer in Europe, aggressively increasing its gold reserves recently to record levels. The head of the National Bank of Poland explicitly stated that he wants 20% of reserves in gold. He cited the safety and the lack of counterparty risk as the primary drivers for this strategic move. This is a NATO member and a European Union nation losing faith in the paper currency system publicly. It signals that the distrust of the dollar is not limited to America's geopolitical rivals or enemies anymore. Even our allies are looking at the $38 trillion debt pile and getting nervous about repayment. They see the interest payments on U.S. debt consuming the entire federal budget, and they do the math. They know that the only way the U.S. can pay its bills is to print more dollars endlessly forever. This guarantees that the purchasing power of the dollar will continue to degrade over the coming decade rapidly. Central bankers are conservative by nature, and their primary job is to preserve the nation's wealth at all costs. They are voting with their wallets, and that vote is a resounding no confidence in the Federal Reserve. The sheer volume of gold leaving the vaults of London and New York is staggering to comprehend today. We are seeing a physical flow of wealth from the west to the east that is historic in scale. Refineries in Switzerland are working overtime to melt down large western bars into smaller eastern bars for export. The 400-ounce London Good Delivery bars are being recast into 1-kilogram bars for the Asian market. This transformation is physical proof that the gold is not just being traded, it is being moved physically. It is leaving the financial centers of the West and entering the strategic reserves of the East permanently. This migration of gold is a leading indicator of a shift in global economic power dynamics occurring now. The country with the most gold has the most leverage when the fiat currency system eventually resets itself. History teaches us that all paper money systems eventually return to their intrinsic value of zero over time. The average lifespan of a fiat currency is roughly 27 years throughout history before it fails. The US dollar has defied the odds since 1971, but the cracks are now visible everywhere. The central banks know this history better than anyone else because they are the ones studying it daily. They are hedging their exposure to the inevitable devaluation that must occur to clear the massive debt load. The buying is also driven by the desire to create an alternative settlement currency for global trade deals. The BRICS nations have been vocal about their intention to reduce reliance on the US dollar for commerce. Gold provides a neutral and trustless asset that can be used to settle trade imbalances between sovereign nations. If India buys oil from Russia, they can settle the difference in gold if the currencies are volatile. This return to a quasi-gold standard for trade is already happening in the shadows of the market today. It explains why the price of gold has remained resilient even when interest rates were historically high recently. Normally, high interest rates are bad for gold because they increase the opportunity cost of holding it. But in this cycle, gold ignored the high rates and continued to climb higher and higher regardless. This decoupling of gold from real rates is the smoking gun of central bank intervention in the market. They are buying regardless of the price and regardless of the interest rate environment to secure ounces. They are price-agnostic buyers because their motivation is strategic security, not quarterly profit or gains. They're not trading for a 10% gain, they are insuring against a 100% loss. This type of buying puts a permanent floor under the price of the metal that cannot be broken. Every time the price dips, the central banks step in and scoop up more physical inventory immediately. This prevents the price from crashing and creates a one-way street for the market long term. The retail investor is largely unaware of this dynamic because the mainstream media ignores it completely. CNBC and Bloomberg focus on the daily gyrations of the stock market and the latest tech earnings reports. They rarely discuss the slow-moving tectonic shift occurring in the central bank vaults around the world. But the data from the World Gold Council is public for anyone who cares to look at it closely. It shows a consistent and relentless bid for physical gold that shows no signs of stopping soon. In 2025, the buying broadened to include countries like Singapore and Iraq and India as well. The Reserve Bank of India has been quietly accumulating gold to diversify its massive forex reserves recently. They are traditionally conservative, but even they are moving into the yellow metal aggressively to hedge risks. This global participation confirms that this is not just a China story or a Russia story alone. It is a global phenomenon driven by a systemic loss of trust in the US government's fiscal sanity. The United States is running deficits of $2 trillion a year during peace and prosperity times. There's no political will in Washington to cut spending or raise taxes to balance the books today. The only way out is inflation, and the central banks of the world know this fact very well. They are front-running the inflation by buying the one asset that cannot be inflated away by governments. Gold cannot be printed by a central bank or debased by a politician looking for votes in November. It requires energy and labor and capital to mine an ounce of gold from the Earth's crust. This scarcity is what gives it value in a world of abundant and infinite paper money supply. The disconnect between the paper price of gold and the physical demand is growing wider every single day. On the COMEX futures market, billions of dollars of paper gold are traded every day without delivery. But in the physical market where delivery is taken, supply is becoming tighter and tighter for buyers. Dealers are reporting delays in sourcing large bars for institutional clients and family offices right now. The premiums on physical coins and bars are creeping up as the supply chain gets squeezed tightly. This is the early warning sign of a potential delivery failure in the future of the exchange. If too many people stand for delivery on the futures market, there will not be enough gold available. The central banks are taking delivery and removing that metal from the circulating supply forever into vaults. Once it goes into a sovereign vault, it does not come back out for decades, usually if ever. This reduces the available float for investors in industry and jewelry makers significantly in the open market. The supply-demand mechanics are aligning for a massive squeeze higher in the price of the metal. But the price is secondary to the message that this buying sends to the world right now. The message is that the era of the US dollar's exorbitant privilege is coming to an end. We are entering a multipolar financial world where the dollar is just one of many options available. And in that world, gold is the only neutral reserve asset that everyone agrees on universally. It is the ultimate form of money that has survived every empire and every collapse in history. The central banks are betting on gold because they are betting against the politicians and their promises. The mathematical reality of the United States federal debt is the primary driver of this historic gold rush. Central bankers are looking at the exponential growth of US government spending with absolute horror and disbelief today. They see a debt pile that has grown to over $38 trillion in a terrifyingly short amount of time. But the scary number is not the total debt, it is the interest required to service that debt annually. For the first time in history, the US government is spending more on interest payments than on the national defense budget. This creates a doom loop where the government must borrow more money just to pay the interest on old debt. It is the definition of a Ponzi scheme, and every central banker in the world knows exactly how this story ends. There are only two ways out of a debt trap of this magnitude for any sovereign nation in recorded history. The first option is a hard default, where the government simply refuses to pay its bondholders what is owed to them. This would cause a global financial collapse that would make the Great Depression look like a picnic by comparison. The second option is a soft default, where the government prints money to pay the debt with devalued currency. This inflates away the real value of the debt, but destroys the purchasing power of the currency simultaneously and permanently. The central banks are betting heavily that the United States will choose option 2 because it is politically easier to execute. They know that no politician will ever stand up and tell the American people that the country is bankrupt today. Instead, they will quietly print trillions of dollars to keep the illusion of solvency alive for a few more years. This printing presses the value of the dollar down and pushes the value of hard assets like gold up. When a central bank buys gold, they are effectively shorting the dollar and betting on inflation to rise rapidly. They are protecting their nation's purchasing power from the inevitable debasement of the world's reserve currency in real time. This is why we see countries like Turkey and China and India leading the charge in gold accumulation strategies. They have lived through currency collapses in their own history, and they recognize the warning signs clearly on the horizon. They see the United States making the same fiscal mistakes that led to the collapse of other empires in the past. The weaponization of the dollar is the accelerant that turned this smoldering fire into a raging inferno recently. For decades, the world accepted the dollar because it was neutral and apolitical and open to everyone equally. But when the US government started using the dollar as a tool of foreign policy, that trust evaporated overnight. Sanctions are a powerful weapon, but they have a massive long-term cost that is now finally coming due. Every time the US sanctions a country, it incentivizes that country to find an alternative to the dollar system immediately. We have forced our adversaries and even our neutral trading partners to build a parallel financial system for survival. Gold is the foundation of that parallel system because it requires no permission from Washington to use or transport. You can fly a plane full of gold from Moscow to Shanghai and settle a trade without the SWIFT system involved. This physical settlement capability is a strategic asset in a world of increasing geopolitical fragmentation and conflict today. The smart money is moving away from digital promises and back to analog reality for safety and security reasons. This shift is happening at a time when the supply of new gold is becoming harder to find geologically. Mining companies are struggling to replace the ounces they dig out of the ground every single year of operation. The easy gold has already been found and mined, and the new deposits are deep and expensive to reach. This peak gold dynamic adds a supply shock to the demand shock coming from the central banks right now. When you have falling supply and rising demand, the price has only one direction to go in the long run. But the price of gold in dollars is actually a misleading metric if you think about it deeply enough. It is not that gold is going up, it is that the dollar is going down relative to real assets. Gold is the constant measuring stick of value that has remained stable for 5,000 years of human history. An ounce of gold bought a high-quality toga in ancient Rome and a high-quality suit today in New York. The dollar has lost 98% of its purchasing power since the Federal Reserve was created in 1913. The central banks are simply acknowledging that this trend of devaluation is accelerating rapidly in the 2020s decade. They are swapping a melting ice cube of fiat currency for a permanent store of value in physical gold bars. This logic is irrefutable, but the average American investor is still chasing the stock market bubble blindly today. They are distracted by the nominal highs of the Dow Jones and ignoring the real inflation in their daily lives. The stock market can go up in nominal terms, while the real economy collapses in purchasing power terms entirely. We saw this happen in Venezuela, in Zimbabwe, where stocks soared as money died, and central banks are not fooled. They look at the fundamentals of the balance sheet and the quality of the collateral backing the system today, and they see that the collateral of the US Treasury market is being diluted by excessive issuance daily now. The bond market vigilantes have returned, and they are demanding a higher yield to hold US debt risk. This pushes interest rates up and makes the interest on the debt even more unaffordable for the government budget. It is a vicious cycle that has no mathematical solution other than massive currency devaluation eventually to clear the books. The Federal Reserve is trapped between fighting inflation and saving the government from insolvency right now in this cycle. If they keep rates high to fight inflation, they bankrupt the government with interest payments on the debt pile. If they cut rates to save the government, they reignite inflation and destroy the dollar's value further and faster. The central banks of the world see this trap, and they are getting out of the way before it snaps. They are front-running the inevitable pivot, where the Fed sacrifices the dollar to save the system from collapse. This is why the gold price has been so strong, even in the face of a strong dollar index recently. Traditionally, gold and the dollar move in opposite directions on the chart like a seesaw effect in markets. But in this new paradigm, they are rising together because gold is pricing in the future failure of the dollar. It is a warning signal that the market structure is breaking down and correlations are changing permanently for investors. The Global South is particularly aggressive in this move because they have been hurt by the dollar before historically. Countries in Africa and South America are tired of importing American inflation through the dollar standard and paying the price. When the Fed raises rates, it crushes the economies of developing nations who borrowed in dollars to build infrastructure. They are buying gold to gain monetary independence and protect themselves from the decisions of the Federal Reserve Board. This desire for sovereignty is a powerful force that is reshaping the global financial landscape today and tomorrow. We are moving from a unipolar world dominated by the US to a multipolar world of competing currencies and assets. In this chaotic transition period, gold is the only asset that provides stability and neutrality for sovereign nations. It is the bridge that gets you from the old dying system to the new emerging system safely and securely. The central banks are building that bridge with thousands of tons of metal bought in the open market daily. They are draining the liquidity from the London and New York exchanges to build their strategic stockpiles for safety. This leaves less gold for the private sector and for the exchange-traded funds that retail investors buy typically. We are seeing a divergence where paper gold is being sold by Western investors, while physical gold is bought by Eastern banks. This flow of metal is a transfer of wealth from the impatient to the patient, and from the West to the East. Western investors are selling their insurance policy just as the house is catching on fire right in front of them. Eastern central banks are buying that insurance policy because they smell the smoke clearly and see the flames rising. The disconnect between these two groups creates a massive opportunity for the contrarian investor today who is paying attention. If you follow the central banks, you're betting on the same side as the entities that print the money. They have the power to create infinite currency, but they cannot create infinite gold to solve their problems. This asymmetry is the key to understanding the trade of the decade that is unfolding right now in markets. The scarcity of gold is absolute, but the scarcity of dollars is artificial and easily changed by policymakers. When the next crisis hits, the response from Washington will be the same as it always is in crisis. They will print trillions of dollars to bail out the banks and the pension funds and the government itself. This flood of new money will dilute the value of every existing dollar in your bank account immediately. It is a hidden tax on savers and workers that transfers wealth to the owners of assets without a vote. The central banks are positioning themselves to be on the receiving end of that wealth transfer right now. They are holding the asset that will reprice higher when the currency is debased by the printers. Eventually. This is not speculation. It is a defensive strategy executed by the most conservative institutions on Earth today. They are not gambling on a crypto token or a meme stock or a tech startup for gains. They are buying the only form of money that has no liability attached to it whatsoever in the world. The fact that they are doing this in record size should be the only signal you need to act. It tells you that the people who run the casino are cashing out their chips and leaving the table. They know that the game is rigged and that the mathematics of the debt are unsustainable in the long run. The mainstream narrative is that everything is fine and a soft landing has been achieved by the Federal Reserve. But the actions of the central banks tell a completely different and much darker story about the future economy. They are preparing for a hard landing that will shake the foundations of the global economy to its core. They are building a fortress of gold to withstand the coming storm of volatility and default and inflation. This fortress will allow them to restart their currencies and their economies after the crash settles down eventually. Those who do not have gold will be left holding paper promises that are worth less and less every day. The purchasing power of the middle class is being eroded by this silent inflation every day of the week. You feel it at the grocery store, in the gas station, and in your insurance premiums rising constantly. But the official government statistics manipulate the data to make it look like inflation is low and under control. The central banks do not rely on the CPI report to make their investment decisions or set their policy. They look at the money supply and the debt levels and the geopolitical risks in the world today, and everything they see points to higher inflation and a weaker dollar in the future of the global economy. This is why they are buying the dip and buying the rip and buying at all-time highs relentlessly. They are not trying to time the market. They are trying to secure their survival in a dangerous world. The urgency of their buying suggests that they believe the timeline for this reset is short and approaching fast. They are not accumulating this gold over 50 years. They are doing it in 5 years to be ready. This accelerated timeline means that the window of opportunity for the individual is closing fast and permanently for many. As more gold moves into firm hands, the liquidity in the market dries up quickly and premiums rise higher. This leads to higher volatility and higher premiums for anyone trying to enter the market late in the game. The time to buy insurance is before the fire starts, not while the house is burning down around you. The central banks have already bought their insurance, and they are continuing to buy more every single month. They are signaling that the fire is inevitable and that the fire trucks are not coming to save you. The financial system is fragile and leveraged and dependent on confidence to survive daily operations and trade flows. When that confidence breaks, the rush into real assets will be like water bursting through a dam violently. The ultimate irony of this financial reset is the hypocrisy of the central bankers themselves. While they are aggressively buying physical gold for their own vaults, they are telling you to buy digital tokens. They disparage gold publicly as a barbarous relic or pet rock while privately hoarding it like dragons. This dual narrative is designed to keep the public distracted, while the smart money secures the lifeboats. The central banks understand that the current fiat currency system is reaching its mathematical expiration date. They are preparing to transition the world into a new system based on central bank digital currencies. This new system is not designed for your convenience or your safety or your financial prosperity. It is designed for total control and total surveillance of every single transaction you make in your life. The gold that they are buying is the collateral that will give them the power to issue these new digital currencies. They need a hard asset on their balance sheet to restore confidence when the paper dollar finally collapses. But they do not want you to own that hard asset because it gives you freedom from their system. If you own physical gold, you have a form of money that exists outside of the digital control grid. You can transact privately and independently without the permission of a bank or a government algorithm. This financial sovereignty is the one thing that the architects of the new system fear the most. That is why we are seeing a coordinated war on cash and a push towards a cashless society. Cash is the last vestige of privacy in the daily commerce of the American citizen today. When cash is gone, you will be forced to use their digital rails for everything from coffee to rent. And once you are trapped in that digital pen, they can impose negative interest rates on your savings. They can put an expiration date on your money to force you to spend it to stimulate the economy. They can turn off your ability to buy certain goods if your carbon footprint or social score is too high. This sounds like science fiction, but the technology to do this is already built and being tested. The FedNow payment system is the infrastructure that lays the groundwork for this digital dollar. The central banks are buying gold because they know that their digital tokens will eventually be rejected. They know that trust is the only thing backing a currency, and trust in government is at an all-time low. So they are anchoring their new system to the oldest and most trusted asset in human history. They are trying to have their cake and eat it too by owning the gold and controlling the ledger. But you have the opportunity to front-run this strategy by becoming your own central bank today. You can look at what they do and ignore what they say and position your family accordingly. The accumulation of gold by the average citizen is a vote for freedom and a vote against technocratic control. It is a way to opt out of the inflation tax that steals your labor and your time silently. When you trade your devaluing dollars for gold, you are effectively shorting the corruption of the state. You're moving your wealth from a liability that they can print to an asset that they cannot print. This simple act of preservation is the most powerful protest you can make in the financial world, but you must understand the difference between paper gold and physical gold to be truly safe. Buying an ETF or a futures contract is not the same as holding the metal in your hand. In a true systemic crisis, the paper market will likely freeze or force settle in cash, not metal. You will get a check for the dollar value of your gold, but you will not get the gold itself, and that check will be denominated in the very currency that is collapsing in value at that moment. This is why the central banks take physical delivery and move the bars to their own sovereign soil. They know that possession is 9/10 of the law in a world where contracts are broken. They are not trusting a custodian in London or New York to hold their wealth for them anymore. You should adopt the same mentality and minimize your counterparty risk as much as possible. If you cannot hold it, you do not own it is the golden rule of the reset era. The window to acquire physical metal is still open, but the supply chain is showing signs of stress. As the central banks continue to vacuum up the available supply, the retail market will get tighter. We are already seeing premiums on silver and gold coins detach from the spot price on the screen. This divergence is the free market telling you that the paper price is a lie and the physical price is real. The real price of gold is much higher than what you see on the ticker tape on television, and it will go much higher as the velocity of money picks up and inflation returns with a vengeance. The Federal Reserve has lost control of the narrative, and they have lost control of the bond market. They are now just reacting to crises and trying to patch the holes in the sinking ship. The buying of gold by the central banks is the captain and the crew getting on the lifeboats. They are not announcing the evacuation because they do not want to cause a panic on the deck. But if you are watching their actions, you can see exactly what they are doing and why. They are leaving the passengers to go down with the ship of fiat currency and unpayable debt. You have a choice to make right now while the waters are still relatively calm and navigable. You can stay on the ship and hope that the government will save you when the crash happens. Or you can build your own raft and secure your own future by following the smart money. The history of the last 100 years is a history of wealth confiscation through inflation. The dollar has lost 98% of its value, and the process is accelerating, not slowing down. Gold has preserved its purchasing power through wars and depressions and hyperinflations for centuries. It is the only financial asset that is not someone else's liability or promise to pay. It is pure equity and pure ownership in a world of debt and leverage and derivatives. The central banks know this truth, and that is why they are stacking bars to the ceiling. They are not buying Bitcoin or real estate or stocks with their reserve assets right now. They are buying the one thing that has never gone to zero in 5,000 years of trade. This fact alone should give you the confidence to allocate a portion of your portfolio to this sector. You do not need to put everything into gold to protect yourself from the coming storm. Even a 5 or 10% allocation can be the difference between ruin and survival. It acts as the insurance policy that pays out when everything else in your portfolio is failing. But unlike car insurance or house insurance, you get your premium back when you sell the gold. It is a savings account that grows in value as the currency is debased by the printers. The path ahead for the American economy is going to be volatile and difficult for many people. The standard of living will continue to decline as the cost of living continues to rise. The middle class is being hollowed out, and the gap between the haves and have-nots is widening. The haves are the ones who own assets, and the have-nots are the ones who hold currency. Do not be the person holding the bag of confetti currency when the music finally stops playing. Be the person who looked at the data and saw the warning signs and took action early. The central banks have shown you the playbook, and they have shown you the timeline by their urgency. They are panic buying now because they know that the time left to prepare is running out. You should feel that same sense of urgency when you look at your own financial situation today. Do not wait for the government to tell you that there is a crisis before you act. By the time they admit there is a crisis, the banks will be closed and the ATMs empty. The time to prepare is when everyone else is sleeping and the system still functions normally. We are living through a historical turning point that will be written about in textbooks for decades. The end of the dollar standard and the return of gold is the biggest story of our lifetime. You have a front row seat to this event, and you have the power to protect yourself. Thank you for watching this 3-part deep dive into the central bank gold buying phenomenon. We have covered the data and the reasons and the solution to this existential financial threat. If you found this series valuable, please subscribe to the channel and share it with someone you care about. The algorithm suppresses this kind of truth, so we rely on you to spread the message. Leave a comment below with your thoughts on CBDCs and if you would ever use them. I will be reading your comments, and I look forward to seeing you in the next video. Stay safe and keep stacking, and never trust a politician with your financial future.